With stock prices still below where they were at the beginning of the decade, and with the crash of 2008 still fresh in many investors' minds, many people are understandably skittish about pinning the fortunes of their retirement accounts on the stock market. Which leads to an interesting question. Do you really have to invest in stocks in order to have a comfortable retirement? The answer, of course, is no. It is possible to accumulate a nest egg large enough to retire on even if you avoid stocks entirely. Indeed, Boston University economist Zvi Bodhi told Money Magazine last year he believes that many people should keep their retirement savings in safe assets whose value won't go down rather than risky stocks. But while a no-stock strategy may make you feel more comfortable in the sense that you don't have to worry about the market's ups and downs, there's another aspect to adopting it that I think makes foregoing stocks entirely inappropriate for most people. The reason is that although stocks can be risky and have performed abysmally in recent years, over the very long run, they typically provide much higher returns than more secure investments like bonds, CDs, and money market funds. Granted, those higher returns aren't guaranteed, but it's rare that safer investments beat stocks over periods of 10 or more years. If you're saving for retirement, those higher returns mean you can accumulate a much larger nest egg with a given level of savings by putting at least some of your money in stocks rather than in investments that offer more stability in the short term. You can get a sense, though, of how much more you might have to put away each year by going to T. Rowe Price's retirement income calculator and running several scenarios with varying levels of stock exposure. I think you'll be surprised to find out how much extra saving you need to do if you avoid stocks. For example, I recently ran some scenarios for a hypothetical 32-year-old earning $50,000 a year who wanted to retire on 75% of his pre-retirement income and had already saved $25,000 for retirement. Assuming a portfolio of 70% stocks and 30% bonds during his career and 30% stocks, 70% bonds in retirement, my hypothetical 32-year-old would have to save about 12% a year, or $6,000 annually today, to have a 70% chance of generating 75% of his pre-retirement salary after retiring. So how much extra saving was required without stocks? Well, with a 100% bond portfolio, the required annual savings jumped to 16% of salary, or $8,000 this year, a 33% increase from $6,000. And what if my fictional 30-something retirement investor went really conservative and put his entire portfolio in cash and cash equivalents? He would need to save 25% of salary, or $12,500 a year, to have a 70% chance of hitting the target income level. Now, I don't want to downplay the risks of investing in stocks. Stocks are volatile, and that volatility never goes away no matter how long you hold them. That's why you want to scale back the percentage of your portfolio you devote to stocks as you get older. You don't want to suffer a huge loss as you near retirement or after you've actually retired. Bottom line, you certainly don't want to overdo it with stocks. But despite their spotty record over the past decade, I think it still makes sense to devote at least some of your retirement portfolio to equities. That said, if you prefer to avoid stocks, whether it's because you don't like the stomach-churning volatility or you have doubts about their future prospects, you can certainly get by without them. But if you take that route, you better start ramping up your savings rate big time.